Hi, everybody. Thank you so much for joining. Another busy day, huh? Two central bank meetings. One is from the Bank of England. That has just happened. And then this evening, we've got the Federal Reserve in the US. Both central banks have cut or are expected to cut rates. The Bank of England cut by 25 basis points today. That was totally as expected. The vote split was 8-1. So 8-1 in favour of a cut with Catherine Mann. She's a very noted hawk. She decided to keep rates on hold. It does suggest that she is a hawk, so one would expect her to be a little bit more sceptical about rate cuts. But there had been an expectation of 7-2 split. So it suggests that maybe the hawks haven't got as much control over the Bank of England as first thought. The immediate impact has been a stronger pound versus the dollar, so it's in recovery mode. Now, is this because of the Bank of England? Is this also because we saw that massive rally in the dollar yesterday? So it's quite normal for the pound, for things to pull back a bit in the days after that. But the things that we would point out is that in the Bank of England didn't just cut rates today, they also released a statement. They released their minutes for their meeting, and they released the latest monetary policy report, the last one of the year. So that has their longer term growth and inflation forecasts. Now, there's three things to remember from this Bank of England meeting that could help UK markets a little bit and help your understanding of UK markets for sure. The first one is that they said that they would gradually cut rates. Now, that is a shift in language. So there's going to be a gradual lowering of interest rates. Things to remember about that: they are still continuing to cut interest rates, but at a gradual pace. So maybe not as fast as expected. And in the immediate this meeting, we have seen a reduction in expectations, certainly for a rate cut in December. Now, that is pretty much, the market doesn't think that will happen. That's fallen to 22%. That had been 33% before at the start of this week. So there has been an impact from that. It had been about 65% before the budget last week. So a lot of these moves are continuations of the moves that we've seen since the budget. Now, talking of the budget, the Bank of England meeting this week, it was never just going to be about cutting interest rates, was it? It was also going to be about the impact on the UK's budget, on growth and inflation forecasts, and also the impact on the from the US elections. So let's look at the budget first. They revised up their growth expectations in the longer term. So they're saying that the budget will have an impact of boosting GDP by about 0.75%, and that will happen in 2025. So very much in line with the OBR's forecasts. The impact on growth from this budget is fairly minimal, and it will happen in the short term. It's not necessarily happening in the long term. Also, inflation, they've revised up their forecast by 0.5%. So this budget is marginally or slightly inflationary as well. But I think what we're seeing in the market is a stronger pound, but very strangely, we're seeing yields fall back. Now, partly that's because there's issues going on in Europe at the moment. Germany's got to have another election. Coalition has collapsed, and we've also got maybe a bit more focus on the fact that France hasn't even passed its budget yet. So European bonds are selling off. US bonds, they're in recovery mode after their big sell-off, and that's the same with the UK. In fact, yields are actually falling. Now, that's because the Bank of England didn't revise up their long-term inflation forecast. What they think will happen with the budget is that it will push inflation back above 2% sooner than what they expected in August. So it's not going higher, but it is going back above 2% sooner. So that's why that's happening. And that's why we've seen bond yields come off, but the pound has received a bit of a boost. Pound's also in a bit of recovery mode as well, as I said. Now, if we can look at the first chart, this shows global stock markets. So the orange and the white line, they're the S&P 500 and the Russell 2000. The green line is the Euro Stoxx 50 index, so 50 of the biggest stocks in Europe, and the yellow line there is the FTSE 100. Now, I'm just showing you this chart because yesterday we saw a massive increase in US stock markets after the Trump win and the big win for Trump and the Republicans in the US. I spoke about it yesterday on my live, but it really has pushed higher. And what you can see here is a big divergence. US stocks doing really well, the other stocks doing not so well. If we look at the second chart now, I'll also show you the impact of the Trump trade and the win for Trump on US Treasury yields. Now, this is the 2-year US Treasury yield. So as you can see, a big increase. It had been falling as the Federal Reserve had been cutting interest rates. Now there's been a bigger increase. That needs to factor into what the Federal Reserve is going to do. So the Fed will meet tonight. They are expected to cut interest rates by 25 basis points. Now, we're not going to get their updated forecast. We're not going to get a dot plot. So we don't necessarily know what they're going to do going forward. And we think that they will refrain from telling us too much. And that is because we've got a new president coming in with big ideas about tariffs that could hit inflation and could potentially hit growth as well. So there's a lot of unknowns there. So we think that they're going to be very, very careful about what they're saying. And that's why that's why kind of the dollar is leveling out a bit. But overall, we think stock markets will continue to look at what Trump is doing, but we could potentially see a little bit more slightly hawkish bias. The market thinks the Fed will be hawkish tonight. If we just look at the third chart very quickly, which shows US interest rate expectations. Now they really have pushed up higher. So we've seen US interest rates, they have increased slightly by about 20 basis points in a year's time. So that's the implied interest rate. So that has moved higher in the aftermath of the win for Trump. We think that will be reflected by the Fed tonight, that the market has already moved on that. And we think that so ultimately that means two things. Right now, the surge in yields and expected increases in interest rates, that hasn't hurt US stocks, which is interesting, right? So, but we think that US stocks could be vulnerable if Treasury yields continue to rally. That could depend a bit on what the Fed says tonight. If they sound very hawkish on the back of this Trump win and expected tariffs, etc., then we could see stocks start to sell off, particularly those smaller cap stocks in the US. However, if they stay quite neutral, then we might just see things leveling off a bit rather than actually selling off. But we do think the Fed will try to steady the ship. So maybe some of those animal spirits that we saw yesterday will be flattened or numbed a little bit by the Federal Reserve, who will possibly be very, very cautious in their outlook when they meet later today. So that's it from me. But thank you so much for joining, everyone. We really appreciate everything and you joining us and reading all our research, etc. So thank you so much for joining. Speak soon.